It's significant news when central banks hike interest rates. It has the potential to reverberate across the economy. It has the potential to undermine consumer confidence, lead to fewer employment and lower salaries, and cause stock values to plummet. So, what motivates central banks to boost interest rates? Let's start with the fundamentals. If you borrow money, you'll have to pay a little more to make the lender happy. This is the interest rate. Whenever you take out a loan, you want the interest rate to be as low as possible so that you don't have to pay as much back. On the other hand, if you want to save money, a high interest rate implies you may make more money. Consider it a reward for leaving money in your account. Nevertheless, the extent of your reward is determined by the conditions. In the economy, there is no one interest rate. There are thousands of banks that set their own business rates. But all of this is impacted by the interest rate set by the central bank. A central bank functions similarly to a bank for banks. Banks, like you and your savings account, receive interest when they deposit funds with a central bank. Reserves are assets held by commercial banks. That's similar to their cash on hand. Commercial banks can lend their excess reserves to one another at interest, and they can also deposit their excess reserves with the central bank. And by doing so, they can earn an interest rate. Regular people cannot access the interest rate on extra reserves, yet it impacts them anyway. That is the concept. When central banks boost interest rates, they are attempting to keep inflation under control. How quickly costs increase for everyone. Central banks such as the Federal Reserve, the Bank of England, and the European Central Bank are all attempting to meet a 2% inflation target. Interest rates are a very significant instrument that they have. When inflation is deemed excessive, banks hike interest rates. The adjustment extends across the financial system, slowing the rate of inflation. This is how. When a central bank raises interest rates, commercial banks earn more on their reserves. They may make more money by holding their money in a central bank than then lending it out. If they do lend it out, they will hike their interest rates to make it worthwhile for them to do so. The economy will determine how this impacts customers. Consider mortgages. Many people in countries such as Finland and Australia have variable rate mortgages. If you have a variable rate mortgage where the interest rate you pay is connected to the central bank's interest rate, higher interest rates mean that you will have less cash to spend on other things right away. Households will spend less if they have less extra cash. And with reduced spending, firms will be more hesitant to raise prices. This should reduce inflation. Fixed-rate mortgages are more common in other nations, such as the United States and Canada. Individuals with fixed rates are safe from the direct consequences of interest rate increases, but they will still suffer the indirect effects. Mortgages will grow more costly as interest rates rise. If this affects all new purchasers, housing values will start to decrease. As a result, everyone who owns a home will feel poorer, and they may spend less. Lowering expenditure will result in reduced inflation. Not only will shoppers tighten their purse strings. When interest rates rise, it becomes more expensive for firms to borrow and invest. In general, this equals less economic activity. It is possible that fewer employment will be produced as a result. Fewer employment and lower pay may mean less money for families. And consumer confidence may suffer, which also implies less purchasing. As interest rates rise, it tends to limit consumption, investment, and overall economic activity. Generally, firms will be more hesitant to boost their pricing, which will tend to slow inflation. It appears simple, doesn't it? The problem is determining how far to go. The Federal Reserve, America's central bank, permitted interest rates to reach a record high of 19% in 1981. The move reduced inflation, but it caused broad economic harm. It is extremely difficult to manage inflation without drastically hampering economic activity. In the United States, it has been more than 70 years since inflation fell below 5% without precipitating a recession. A little inflation is okay. It keeps the economy going forward at a reasonable pace. Yet, very high inflation is a concern. Increasing pricing needs greater compensation for employees, driving up corporate costs. This might push prices further higher. potentially resulting in a downward spiral of wages and prices. Central bankers are quite worried about setting inflation expectations. The argument is that if it can demonstrate credibility, that it would always act to bring inflation back down to 2%. It may not need to raise and then drop interest rates in this seesaw form. Increasing interest rates can severely impede an economy. The issue is that the brake pedal has a delay. It might take up to 2 years to observe the full impact of interest rate increases. Because central banks are aware of this, when they set interest rates, they are attempting to read the road ahead, yet forecasting the future is difficult. The difficulty is that the central bank cannot predict whether inflation will decline on its own. Even if central banks get it right, they might still spark a crash. Although it is a blunt instrument, hiking interest rates remains central banks' primary tool for containing inflation. Indeed, central bankers would reply, rising interest rates is unpleasant. Slowing the economy is unpleasant, but it's well worth it. It's worth it to achieve low and consistent inflation so that you don't have to worry about it in the long term.